The stock market looks like numbers on a screen, charts, percentages, prices moving up and down. But beneath all of that, the market is driven by just two forces: fear and greed. Not logic, not math, not intelligence, emotion. And this is the part most people don't fully understand. The market is human. Every trade represents a decision, someone buying, someone selling. And those decisions are made by people, people with emotions, biases, pressure, pride, and panic. Even when computers execute trades, the strategies behind them are built by humans, reacting to human behavior. That's why markets move the way they do. The market isn't a clean equation, it's a massive global crowd, and crowds are emotional. Fear and greed are not random weaknesses, they're survival instincts. Greed pushes us to pursue opportunity, fear pushes us to avoid danger. In normal life, these instincts can be useful. They help us take chances and they help us stay safe. But in markets, these same instincts become dangerous because the market rewards behavior that often feels unnatural. The market rewards patience, discipline, and long term thinking, while fear and greed push you toward impulsive, short term decisions. Let's start with greed, because greed is usually where bubbles begin. When markets rise, something strange happens inside the human mind. Success starts to feel deserved. Risk starts to feel invisible. Confidence slowly turns into certainty. People stop asking, what could go wrong? And start asking, how much more can I make? This isn't the cartoon version of greed, it's quiet overconfidence. It's the feeling that the rules have changed, that the story is obvious, that the trend will continue because it has continued. And greed is powerful because it doesn't announce itself as greed, it disguises itself as logic. It sounds like reasoning, it sounds like being informed. People tell themselves, this company is different. This technology changes everything. This trend is unstoppable. The old rules don't apply anymore. Greed feels smart right until it isn't. It makes people feel like they're seeing clarity, when in reality, they're seeing only what supports their optimism. Then the feedback loop begins. Rising prices create confidence. Confidence attracts buyers. More buyers push prices higher. Higher prices become proof that the story is true. And as the story spreads, more people join. Not because they've done careful analysis, but because they don't want to miss out. This is FOMO, fear of missing out, which is basically greed wearing a mask of anxiety. People don't just want profit, they want to avoid the pain of watching others win without them. And that is how price can separate from reality, because the market doesn't need perfection to go up, it only needs belief. As long as the crowd believes the future will be better, prices can keep rising. But belief is fragile. Eventually, reality interrupts the story. It can be one disappointing report, one economic shock, one change in interest rates, one unexpected event. Sometimes it's not even a huge event. Sometimes it's just the moment the crowd collectively realizes, maybe we were too confident. That's when greed flips into fear, and fear is even stronger. When markets fall, fear replaces greed instantly. Losses feel personal. Pain feels urgent. Logic disappears. People stop asking, what is this worth long term? And start asking, how do I stop the pain right now? Because fear is not about understanding, it's about escape. Fear doesn't care about your plan. Fear cares about relief, and fear is incredibly persuasive because it also disguises itself as logic. It sounds responsible, it sounds mature. I'm protecting my capital. I'm reducing risk. I'll wait until things stabilize. I'll re-enter when it's clear. But in many cases, this is fear trying to turn panic into a respectable strategy. Selling during fear feels like safety because it feels like control. You pressed a button, you made a decision, you did something. But fear-driven selling often locks in losses that patience would erase. This is the emotional cycle of markets, and it repeats over and over. Optimism turns into excitement, excitement turns into euphoria, then euphoria turns into anxiety, anxiety turns into fear. Fear turns into panic, and the chart follows emotion, not the other way around. People think the chart causes emotion, but most of the time, emotion causes the chart. Price movements are the footprint of human psychology. And here's the key point. Smart people aren't immune. Education doesn't remove emotion. It just gives emotion better explanations. Fear becomes risk management. Greed becomes conviction. Panic becomes being prudent. The emotion stays the same. Only the vocabulary changes. In fact, intelligent people can be more dangerous to themselves because they can rationalize almost anything. They can build a convincing argument to support whatever emotion they're feeling in that moment. This also explains why emotions move prices faster than facts. Facts change slowly. Earnings evolve, economies shift, businesses grow or shrink over time. But emotions change instantly. A crowd can go from confident to terrified in hours. That's why prices can collapse in days and take months or years to fully recover. Not because the world changed overnight, but because sentiment did. When markets move sharply, another psychological effect appears. The illusion that everyone knows something I don't. People see prices falling and assume there must be hidden information. They think, if everyone is selling, they must know something. This triggers herd behavior. People follow movement, not information. They treat the crowd like a signal, even though the crowd is often emotional and wrong at extremes. Following the crowd feels safe because being wrong alone feels terrible, but being wrong with everyone else feels acceptable. Crowds reduce emotional pain, not financial loss. That's why the crowd can drive prices far above fair value during greed and far below fair value during fear. The crowd is not trying to be accurate, the crowd is trying to feel safe. Media amplifies this cycle. Media doesn't create fear and greed, but it magnifies them. During greed, media highlights success stories, overnight millionaires, unstoppable trends, and new eras. During fear, media highlights disasters, worst-case scenarios, and dramatic predictions. This keeps emotional pressure high. It makes the market feel urgent, like something must be done immediately, even when the best decision might be to do nothing. And this is why volatility exists at all. If investors were rational, markets would move slowly. Volatility exists because emotion exists. Fear compresses time. It makes everyone rush. Greed stretches expectations. It makes people believe more is guaranteed. Together they create sharp swings, violent drops, euphoric surges, whiplash reversals. Now here's the long-term paradox that separates amateurs from professionals. The moments when fear feels strongest are often the moments when future returns are highest. And the moments when greed feels safest are often the moments when risk is greatest. Emotion points in the wrong direction. When fear is screaming, prices are often discounted. When greed is cheering, prices are often stretched. That's why most people buy high and sell low, not because they're stupid, but because they're human. This isn't a character flaw, it's biology. Fear and greed evolved to keep us alive, not to make us wealthy. Your brain is designed to avoid pain and chase reward immediately. Markets reward the opposite, tolerate discomfort, and delay gratification. That mismatch is where most investing mistakes come from. So how do long-term investors think differently? They don't eliminate emotion, they design around it, they reduce decision points, they automate behavior, they follow rules when emotions spike. They build systems that make it harder to panic and harder to chase hype. They accept that their feelings will be unreliable at exactly the moments that matter most. That's why discipline beats emotion. Discipline means acting according to plan, not according to feeling. It's boring, it's uncomfortable, and it works, because in emotional moments action feels necessary, but often the best move is no move. Doing nothing is one of the hardest moves in investing because it feels like surrender, even though it can be the smartest form of control. This is the calm advantage. When others are emotional, calm becomes a competitive advantage, not because you know more, but because you react less. Calm protects you from selling at lows. Calm protects you from buying at highs. Calm gives your strategy time to work. And here's something else that's important. Fear and greed never go away. They don't disappear with experience. They don't disappear with wealth. They are permanent features of markets. The goal isn't to eliminate them, it's to stop letting them control you. The investors who win long-term share one trait. They don't trust their emotions. They trust systems, rules, processes, time. They understand that their feelings are not signals, they're noise. And once you internalize that, the market changes. It stops feeling like a chaotic enemy and starts feeling like a predictable emotional machine powered by crowds. So here's the final thought. The stock market is not a test of intelligence. It's a test of emotional control. Fear and greed will always move prices, but they don't have to move you. And the investors who understand that stop reacting to markets and start benefiting from them.